Howdy, Jacob here. Today we're looking at STMicroelectronics, ticker symbol STM, company 115 of our high ROIC screener. We see 38 billion market cap on just under 35 billion enterprise value, with growth being pretty solid. 7 billion in 2014 in revenue to 17 billion in 2023. Dividends relatively flat, no concern there. Earnings per share grown quite a lot. The profits are both up a lot. Gross margin up 14% to 48%, and operating margin is almost as high as what the gross margin was 10 years ago. So very impressive. Last couple of years have had low 20% return on invested capital. Very impressive. Balance sheet shows about $6 billion in cash-like investments and long-term debt at 2.7 billion, just 217 million short-term debt. So no concern from a balance sheet perspective. Good amount of cash on hand, not a lot of debt. They're reinvesting quite a bit back into the business, which you can see by their capital expenditures almost being we're looking at 8 times higher or so for capital expenditures. So they're spending a lot reinvesting back into the business. Use of cash is very heavy on reinvestment. And then we see a little bit of share repurchases. The dividend at 0.8% yield is very small as well. So maybe this is 15% to dividends, 20% to share repurchases, and then 50+% reinvesting back in themselves. So that's great to see them reinvesting when historically they've had these fantastic rates of return on the money invested back in the business. So you definitely want to see the company reinvesting when they have these types of high ROICs. But I think we're ready to make some assumptions here. Let's get right into it. Revenue growth. I know the semiconductor industry is projected to grow double digit, I believe, CAGR over the next couple of years. So I think that seems pretty reasonable to me. Let's maybe do 8%, be a little bit conservative. Although that is quite a bit of growth still, I'm not downplaying that. I think 8% does seem fairly reasonable to me. I think 18 for a P and price for cash flow at the end of 7 years, saying that there'll still probably be growth for this company, and maybe they'll have some sort of a moat, but um, there's just a lot of players in here in this industry, so it'd be difficult to have a true moat there. Margin side, they've been increasing it, so I'll probably put a more on the heavy number there, but the earnings are higher than free cash flow. I don't like that. I love companies that are gushing out more in free cash flow, but they are reinvesting quite a bit through their capital expenditures growing as much as they are. Hey, let's do 16 and 12%. Let's do no share changes. They actually bought back a little bit of shares, but it's because their stock-based compensation is essentially offsetting their share repurchases. So relatively flat seems to make sense to me. The dividend relatively flat. They haven't really increased that much. So we're saying that they're reinvesting into themselves to get this 8% growth rate. And then at the end of 7 years, an 18P seems pretty reasonable to me. They're also reinvesting to get higher margins. So that's why we have here. And right now it just looks a tad expensive here, but honestly, a bit more. This is pretty reasonable. So I could easily see how you could get a good return investing here. I just wanted to fall a little bit more for it to be an obvious buy price. But yeah, I hope you enjoyed the video, and I hope you have a great rest of your day. Thank you.